While buying a rooftop solar solution, the biggest challenge the industrial customer face is to decide whether to buy a rooftop solar solution with their own investment or do it under the RESCO model, wherein the renewable energy developer makes an investment and then the industrial customer pays them a tariff over a term of 15 to 25 years. Most commonly known as CAPEX, whether I should make my own investment, versus the OPEX, whether I should go under the RESCO model. So there is always a battle between the decision about whether to go under the CAPEX model or under the OPEX model in the rooftop solar solution. Hi, my name is Gaurav Kawatra. I am the director at Infinia Solar. Infinia Solar is one of the country's leading marketplace and renewable energy advisors. We have helped and advised over 21 customers, CNI customers pan India across 15 states with over 100 megawatt of rooftop and open access solutions, which has helped them save over 900 crore rupees in their electricity bills. In the last 20 meetings that I have done over the last 2 months discussing rooftop solar solution with various industrial and commercial customers across India, the most common problem that I handled with the CFOs, chief procurement officers, or the directors and the plant managers is, Gaurav, I want to know whether I should invest money while buying a rooftop solar solution, that is the CAPEX model, and whether I should go under the RESCO model, that is wherein the developer invests the capital, that is the OPEX model. So can you help me decide whether I should go for CAPEX or the OPEX model? And trust me, I think in almost all the 20 meetings that I've done, this is the most common challenge or most common problem that most of the industrial and commercial customers are facing. So I decided to make a video so that I can add value to all the industrial customers and the commercial customers who are watching this content and have come up with 5 P's framework to help you decide whether you should go for OPEX or the CAPEX model. And trust me, after watching this video, it will become very easy for you to decide whether to go for CAPEX or the OPEX model. Obviously, there will be some number crunching that you will have to do. I will explain how to do that number crunching in this video. So here are the 5 P's that I'm going to talk about while comparing the OPEX versus CAPEX solution. The first P stands for payback period. So while doing the number crunching under the CAPEX model, the most important parameter for you to consider is what is my payback period. Let's say, for example, a 1 megawatt of rooftop cost you roughly 5 crore of investment or 4.5 crore of investment. Then you need to calculate in how much time this capital that you're investing will come back to you, or you become, that is the payback period. Because the life of the asset is 25 years, so you have to calculate. So how you need to calculate this is look at the investment that you are making, which is your outflow in the year that you are investing this money in this rooftop solar solution, and the inflows that you are expecting from that rooftop solar solution. So the inflows like how much electricity bill that you will save in rooftop solar solution. The customer is entitled to get an accelerated depreciation of 40%. So that will help tax-paying companies to save tax. So calculate how much tax would you save. So these are 2 big savings that you have. And then look at what is your outflow. So you have an outflow, one that you lose tax shield on this OPEX, on this amount. The second outflow that you have is the interest payment that you have to make. Third outflow is the repayment of the capital. And the fourth, the most important, the most ignored outflow is the opportunity cost of the capital that you have invested in the rooftop solar solution. So what I mean by this is, for example, if you invest that money in your own business, which the core business that you are doing, what is the return that you can expect? 18%, 20%. So build that cost while you are investing that money into the rooftop solar solution. So while after doing this mass of your benefits and your outflows, look at what is your net inflow for next 25 years by forecasting this inflows over the next 25 years, and then your outflow is the investment that you are making, and this will give you a payback period which will help you make analysis and what is the payback that you can expect under the CAPEX model. Just to give you thumb rule example, most of the analysis that I have seen, the payback in the CAPEX model, depending upon which state you are, what is your electricity tariff, what is the solar tariff that you are expecting, and what is the generation that you can get on that location, the payback ranges from somewhere from 6 years to 9 years after considering the accelerated depreciation benefit. So once you have calculated your payback period in the CAPEX model, now look at, let's say you are doing a completely OPEX model wherein there is no investment by yourself. So in this model, how you have to do analysis is calculate how much money you are saving in the in year one. For example, let's say if you are doing an OPEX model, let's say you are paying a tariff of 5 rupees and your electricity tariff is around 7.5 rupees, so you would save roughly 2.5 rupees per unit. And for example, if you are going for a 1 megawatt solar solution which gives roughly 14 lakhs of generation, so your saving is somewhere around 32 lakhs rupees in the year one, right? So calculate every year's savings over the next 25 years that you will get once you do the OPEX model. In the OPEX model, the developer gives you option to buy back the project every year at the end of every year, and the buy down values are explained or mentioned in the contract. And if you want to understand what is the buy down value, watch my video here. This link will take you to my earlier video on which talks in detail about what is the buy down value, how is it calculated, what are the factors that determine to calculate the buy down value. So once you have the savings for each year under the OPEX model, second, you have the buy down value for every year in front of you. There is a simple modeling or financial numbers that you will have to calculate. Assume that every year the money that you are saving, you put that money in the fixed deposit at the rate of, let's say, 5.5-6%, and by putting, let's say for example, 32 lakhs that you have saved in year one, assume that you put that money in the fixed deposit, and the value of that money will stand at, let's say in the end of 7th year becomes, let's say, 64 lakhs by just putting that in the FD. Similarly, put every year money in the fixed deposit, and you will have certain cash accumulated at the end of every year, 1 year, 2nd year, 4th year, 5th year, 6th year, 7th year, 8th year. So you will have cash accumulated in your bank account, which is the fixed deposit amount. So this one calculation that you have to do. Second calculation is calculate the buy down value for each year at what price that you can pay to the developer and buy back the project. And then you calculate a year in which the savings which is there in your bank account under the fixed deposit money equals to the buyback amount. So that is something which we call as the NPV neutrality, wherein from the savings coming from the OPEX model itself becomes equivalent to the buyback value. For example, let's say you trigger a buyback at the end of 7th year. So when you're triggering that buyback, you can buy back that project from the savings itself. So that will give you a neutrality when you get the NPV neutral. So this typically comes depending upon the location, generation, etc. This typically ranges from 7 to 9 years in which you become NPV neutral, which means you can buy from the savings itself. So I repeat just to summarize because this is the most important parameter, which is the payback and the financial parameter. In CAPEX, look at what you are investing, look at what is your inflow, look at what are your outflows, then you look at what are your net inflows and calculate the payback period, which typically ranges from 6 to 9 years across different locations pan India. In OPEX, look at the savings that you are getting every year, put that in the fixed deposit rate, then you look at the buy down price and calculate your OPEX neutrality, which typically ranges from 7 to 9 years. So with this payback analysis, you will have financial answer in front of you, whether the payback under the CAPEX model or the NPV neutrality under the OPEX model, which one looks attractive. And I just want to mention this, that with the calculation of NPV neutrality under the OPEX model, because typically the concern for any industrial customer is that in the OPEX model it is a longer tenure contract. So by making this calculation of NPV neutrality, you are actually free from that concern, because your savings itself is making you trigger that buyback and making you net NPV neutral. So second important parameter that you should evaluate, other than the payback period, which is the financial parameter, is the performance guarantee of the project. Since the life of the rooftop solution, everyone knows, is 25 years, which means the project has to run for 25 years for you to get value out of it, complete IRR or complete return out of it. So it is very important to look at the performance guarantee parameter. In the CAPEX solution, evaluate whether the EPC or the O&M provider is giving you guarantee on the units or giving you guarantee for the performance ratio of the plant. So it is very, very important for you to evaluate from the CAPEX perspective, because that project belongs to you. You are the owner and you are dependent upon O&M provider or the EPC installer provider to provide you guarantee, whether it is the units or the performance ratio, as I mentioned. So just to summarize, I have covered so far two key differences, which I called as two P's. First is the payback period. Evaluate the payback period under the CAPEX model. Evaluate the NPV neutrality under the OPEX model. Second key difference is the performance guarantee. Evaluate what is the performance guarantee that you are getting, whether it is generation, whether it is PR under the CAPEX model. In OPEX model, you will definitely get a assured generation from the developer. So I have covered two P's so far. There are three P's more left. I would cover these three P's in my next video with the intent to add value to the viewers. And meanwhile, if you have any queries, any comments related to payback period and the performance guarantee, please share your comments in the comments box below. I or my team will revert to you within 24 hours. Look forward to see you in my next video. Thank you so much for watching.